Hello, welcome to the Nigerian Investor Podcast, TNI for short. This is the unofficial podcast of the Nigerian Stock Exchange. I am your host, Mudiaga, and my co-host, Mr. Ibaemi Aye for short. TNI podcast is dedicated to stimulating a renewed enthusiasm among the general public in Nigeria with regards to investing on the floor of the Nigerian Stock Exchange. Ultimately, the goal of TNI is to see many young Nigerians from all walks of life, both at home and in the diasporas, actively participating in the activities of the Nigerian stock market. Before we go further, we would like to place on record a disclaimer. TNI podcast is solely for the purpose of education and not a replacement for professional financial advice. Let's begin. Hello, welcome to another brand new episode. We are excited to have you here. As usual, it's Taye and myself, Moody, that will be taking this episode. This episode is going to be like a mini episode because it's all rather a multiple episode. This is the first of those episodes. We'll be talking about the benefit of being an investor. A retail investor is an individual investor, not a company that invests in the stock market. You buy shares and you sell shares, and there might be reasons why you want to become an investor. One of the reasons why people want to become an investor is that it could be an avenue for them to create wealth, to earn money on a regular basis. Some of the benefits of being an investor include you earn profits from your investment, and in stock market parlance we refer to profit as dividend. So it is the profit that the company shares at the end of their calendar year, because some companies, their full year financial report comes at during April, some comes during March, some at the end of December. So it's not like the normal calendar year. So it depends on when the company declares or reports their full year earnings and they decide to pay dividends. There are some companies that reward their shareholders on a yearly basis dividends. So they pay them through the registrar that we talked in the previous episode. If you haven't listened to the previous episode, I will advise you go and look for that episode, and it's all about registrar, so you know the role of registrar because it has a lot to do with dividends. So for you to understand how you can earn your dividends, you have to understand the role that the registrars they play and the role that you as an investor need to play for you to receive your dividends on a regular basis. We'll be looking at the dividend as one of the benefits of becoming an investor in the stock market. Aye is going to tell us what dividend is all about and everything that you need to understand about the dividend. Thank you, Taye.
All right. Thank you, Moody, for this exciting episode. I think this is going to be a very interesting one because we're going to be talking about one of the benefits of holding stock. Like you said, it's going to be a multiple series. This is just one of the series on one of the benefits you will gain from holding stock in the stock market. There are other benefits, or you can think of them as two major benefits. And I think you've already mentioned capital appreciation as being one of them. And one of them is dividends. What are dividends to begin with? Well, to begin to understand the dynamics of dividends, I think it's also very important to understand. I think, Moody, you mentioned this, that companies have calendar year, and in this period, they make their profits, right? For most companies on the stock market, their calendar year starts at January 1st or the first working day of January and ends December 31st. This period is a 12-month period. They often record profits. They will often, of course, tell us these the profits they make on a quarterly basis. We have the Q1, which is from January to March. We have the Q2, which is from April to June. And then we have from July to September as the Q3, and then we have from October to December as the Q4 period. And the combination of these quarters is the full year results. Some other companies don't follow the same pattern of starting at January. Some their final year ends at April and so on and so forth. But principally, the financial calendar of most companies is 12 months. And in that 12-month period, they're expected to make profits. Not all companies make profits, of course, but since today we'll be treating on dividend paying companies, the interesting thing here is that majority of companies that pay dividends are making profits. And that's a very good shortcut to knowing a financially stable company is that they are paying dividends and not just paying dividends, but also paying those dividends consistently. Principally, companies they make earnings at the end of a year. Let's say a financial year of 12 months, they make their earnings. And at the end of this period, they will pay a portion of the profits they make as dividends. This portion is usually called the payout ratio, whereas the amount that they tend to retain to reinvest in the company is called the retained earnings, right? And I won't want to go into the details of explaining all of that. I hope we will be able to do so in subsequent episodes explaining these technical side. But the important thing here is that when a company is able to pay dividends and not just once but consistently, and if you remember we've talked about this before, that consistency is very important in investing, and a very good way to gauge the financial health of a company is by looking at how consistent they are with dividend payments, because these dividends are coming from the company's earnings. And if a company is not paying its dividend consistently, you need to check to find out why. Perhaps the company is not also consistent with its earnings. A good example of companies that have stable financial health are companies that pay their dividends consistently. For most companies, they tend to pay dividends once at the end of the financial year. They will declare their dividends after announcing results and all of that. They will declare for their dividends. But some companies tend to pay dividend twice. They will pay for the half year, which is 6 months, and they call this the interim dividends. And then they will pay final dividends again, which is after the remaining 6 months. So pay final dividends. Typically, we see the interim dividends being smaller than the final dividends, and you combine both to form the total dividend paid for the year. And this is usually for the case for most banks on the stock market, and I think a few companies like MTN, Nestle, pay the interim dividends as well. But most banks we know pay, or rather most of the top tier banks, they call them the fugas. We'll go into all of that eventually, but they tend to pay dividends twice, which is the interim dividends and the final dividends. Now, the important thing you have to keep note of here is that for you to qualify for a dividend, first and foremost, you have to own the stock of the company that is paying dividends, right? And it's not just any time, any period you can own the stock which you will qualify for the dividends, right? Typically, what happens is that when a company announces its results, let's say half year results in the case of interim dividends, or full year results in the case of final dividends, or total dividends as the case might be. When they do this, they usually release what we call a corporate action statement. And you can think of this as a kind of documentation which will capture the amount of dividends that will be paid and various details that with respect to that dividend payments. It is in this corporate action that we see very important dates related to the dividends, right? And just to add, you can access this information on the Nigerian stock market website, right? And hopefully we'll be able to share these details with you. When you go to the Nigerian Stock Exchange website, you can always access recent corporate action taken by companies. Usually, when a company has released these results and has announced its dividends, you can then access the corporate action statement to get this dividend information. And what you are seeing in this corporate action document is you see the amount of dividends, you see the kind of dividends, if it's a final dividend or it's an interim dividend, you will see that there. Then the important dates related to the dividends are also there. So what are these important dates? What are these dates that are very important? Well, the first one you need to note is the qualification date of the dividends. So what is the qualification date? It's very important that you keep in mind, like I said, merely owning a stock gives you the opportunity to earn dividends, but you have to own that stock for a period that qualifies you to be entitled to the dividend payment. So when a company has announced its dividends and it has released the corporate action statement, you will see the qualification dates which you have to own the stock by this date in order to qualify for the dividend, right? So between the time when the dividend is announced and the qualification date, investors are encouraged to at least buy and own the stock and hold the stock for this period up until the qualification date, right? And then we have what we call the ex qualification date or the ex dividend date. And this is the day immediately after the qualification dates. And at this period, the registrars, we mentioned this in our previous episode about registrars. So this is the period where the registrars will close their books and begin to record the shareholding structure of the company, which shareholders are qualified for the dividends. So it's very important that you buy the stock on or before the qualification date and not after the qualification date, which is the ex dividend date. You don't buy then. If you want to qualify for the dividends, you don't buy then. But what's interesting is that the Nigerian stock market, they always adjust for dividends on the ex-dividend date. They will subtract the amount that will be paid as dividends on the ex-dividend date from the share price of the stock. Investors who buy on the ex-dividend date can also fortunately capture the stock at a discounted price. However, we always encourage investors that stock market is very unpredictable. While we know ex-dividend dates, the stock will be adjusted. We don't know how the stock price will move between when dividends are announced and that date. So it's always very important that you keep these things in mind. So the ex-dividend date is the date after the qualification date where the stock will be adjusted for the dividends, and all other investors who buy after this date will not qualify for the announced dividends. Then the last important date you have to keep in mind is the payment date. This is the date where the dividends will eventually be paid to shareholders who qualify for the dividends. I like to think of this as the most important date because this is when you finally receive that very sweet dividend that you've been promised by the company for holding the stock. The payment date is just that date. It's exactly what it says. It's a payment date. So it's a date where you receive your money from the company. There's no better feeling that comes from investing in a company and being paid for your holdings. But one interesting thing that I like to note about dividends is that they are very predictable in the sense that they are being paid from the profits of the company. Often, what we see is that we can always track the previous dividend paid by companies, and we can use that to sort of should we say predict what the future dividends of the company is going to look like. And depending on how the company's profits, that is to say the earnings, depending on how these are growing, we can also begin to sort of predict, as it were, the future dividend payment of the company. Dividends are more predictable, they are more stable. And for companies that have been consistent with paying dividends in the past, you can always expect relatively the same consistency with paying dividends in the future. And dividends are a very good way for investors to practice compound interest, because with these dividends, you can buy more shares. And with the shares you buy, you get more dividends and so on and so forth. So you can imagine a situation where you buy shares, you have a set amount of shares. These shares pay you dividends. You then use these dividends to buy even more shares. Now you have more units, and these more units are entitled to more dividends. And if the dividends are increasing, well, you can just begin to imagine just how much you're making over the long term. These dividends are one of the ways we make money on the stock market. And I know for a lot of people, they look at these dividends and they might ask themselves, well, I'm holding a stock and I'm seeing that I'm being paid 1 naira per share or 0.5 kobo per share. It doesn't look much. The interesting thing is that dividends are priced on a per share basis. You want to calculate the total amount you receive by multiplying your units per share by the dividend announced to get your total value of the dividends here. And that just is a very good way to know how much is the total dividends you're going to receive from a company. And like we said, dividends are not the only way you can benefit from investing, but it's a very good way to make good return on investment from companies. Another interesting thing that I would like to add about dividends is, like we mentioned earlier in the podcast, consistency is very important. And with consistency, we are able to predict companies that are financially healthy. And when we see consistent dividend payment, we know these companies will likely keep paying dividends, right? So it's a very good measure of a financial stability of a company, right? And we've noticed that for a lot of companies, mostly in the financial sector, we're talking about the banks, they tend to have this consistency. They tend to have this consistency with dividend payments. So it's also very, very good measure of financial health and stability of a company. So one very important metric that we like to track when it comes to dividends is called the dividend yield. And you can think of this as a kind of return on investment, right, calculation. So basically, what you do is you take the dividend paid and you divide it by the stock price. That gives you the dividend yield of the stock. And we tend to favor companies that have a higher dividend yield because that just means that you're making a higher return on investment. You can imagine a company paying you 1 naira as a dividend and it's trading at 10 naira on the stock market. You can just do the math and you can see 1 naira divided by 10, that gives you a ratio of 10%. So that's a dividend yield of 10%. When a company has a high dividend yield, it means that you're making high returns. When a company has a low dividend, means your returns are lower. Or this is not necessarily saying that company with low dividend yields are bad. We have seen companies that tend to grow very, very fast and they tend to grow their dividends fast as well. While they might spot a low dividend yield today, you buy them today, tomorrow, the dividend grows fast, and next thing you know, your yields are high, right? Based on your purchase price of the stock. So dividends are very, very healthy, very, very good way to invest and make money on the stock market. Modi, I don't know if there's anything I missed out in my discussion.
No, you did a wonderful presentation on that, and I hope listeners will really appreciate that and benefit from that. Dividends are a great way to really encourage you that what you're doing, being an investor, is working fine because it's something that makes you smile to the bank when you receive that alert. It's very rewarding, and you just ask yourself, "Wow, all this for me for just buying the shares of this company." And without having to go to work for that company, without having to answer any question. All you just have to do is your research and be sure that the company that you are investing in is a company that really cares about rewarding their shareholders and trying to make more money for the shareholders. That's the most important thing. Once you've done that, it's more or less like a passive income to me because I've had some stocks that pays dividends and for over 10 years now, and I do basically nothing because I believe in those companies and I wouldn't want to sell my shares in those companies for anything in the world. So what I just look forward to is I keep track of the record, like what I said, the dividends they've been paying. If there is an increment in the dividends on a year-to-year basis, I have an Excel spreadsheet where I keep all those records for 2021, 2022, 2023, 2024. I've been keeping those records, and I've been seeing that my total dividend yield is increasing on a year-to-year basis. So there are some things that Aye talked about that I would want to elicit more response from him, just for the benefit of the listeners. Things like when you talk about the dividend yield, I know if a company releases dividend payment, most analytical metrics that they use in calculating the dividend yield, they usually, most financial analysts, they use the date that the dividend was declared to calculate the dividend yield because the share price of the company fluctuates. But can you enlighten the listeners about the dividend yield more, because what if, for instance, I bought the share when the price was 10 naira, and now the price of that company is 13 naira, and they decide to pay dividend on a particular, they announce their dividend on a particular date when the price was, let's say, 13 naira, and I bought it 10 naira. Will my dividend yield be different from the dividend yield of the day they declared the dividend? Over to you, Taye.
Okay, so what's interesting here is that your dividend yield is going to be calculated on the purchase price of the stock, the purchase price you bought the stock on. The
The
so
price you bought it for.
yeah, the price you bought the stock for, right? That's what the dividend yield will be calculated on. Let's say you bought a stock at 10 naira per share, right? And let us say in some future period, let's say maybe some few months down the line, the stock is now trading at 13 naira per share. The company declares a dividend. Now let's say the company declares a dividend of 1 naira per share. For you who bought the stock at 10 naira per share, it wouldn't matter when the dividend was declared, what the stock price was at when the dividend was declared. You bought the stock at 10 naira per share, so your dividend yield is going to be 1 naira divided by 10 naira, which is going to give you a dividend yield of 10%. However, for someone who bought the stock at 13 naira when the dividend was declared, his dividend yield is going to be 1 divided by 13, which is going to give a dividend yield of approximately 7.7%. While it's important to calculate dividend yield based on the price the stock was trading at when the dividend was announced, while that's a very good practice, it's important that you understand what it costs you to buy the stock relative to the dividends, not necessarily what the stock price is trading at that moment. You can calculate it and figure out what the dividend yield will be based on the current purchase price, but that would only be if you're considering buying more of the stock at that price to see whether it's still a good dividend yield for you personally, right? It's just a matter of relativity, right? What is my own personal dividend yield based on the dividend announced, and what is the current dividend yield based on the current price of the stock? I hope that threw some light on it.
Yes, you did very well, and I hope our listener got the drift very clearly from you. The dividend yield is individualized. Is based on your entry price, the price at which you bought the shares of the company. That is what will determine the dividend yield. But for analytical purpose, most analysts will tell you the dividend yield for a particular stock for this year is 10%, is 5%, is because they use the actual share price on the day that the dividend was declared. So that's what they use. So they tell you. When you see that, don't get confused. Thank you so much, Aye, for that answer. So another question I want to ask you for the benefit of the listeners is, when you talk about the ex-dividend date and the qualification date, you mean to say that on the day of the ex-dividend date, whatever amount that was declared will be taken from the share price of the company that declared the dividends, right? Or what did you say about that? Can you just explain more?
Yes, it's exactly what you said, Moody. So yeah, on the ex-dividend date, that is the day after the qualification date, the stock will be reduced by the amount declared, the dividend amount declared. For a stock that's 1 naira per share was declared as dividend, for example. Let's say the ex-dividend, the stock is trading at 13 naira. So you are going to the exchange is going to subtract 1 naira from the stock price. So you're going to see on the ex-dividend day, the stock is going to be trading at 12 naira per share.
You for that. Then another thing I want to ask before we wrap this up is, what if I as an investor, I want to partake in the dividend. I want to receive the dividend of the company. And at the same time, because I know when a company declares a dividend, most times the share price of the company increases. And I also want to take out profit. I want to sell the shares of that company. Can I do both? Can I eat my cake and have it, so to speak? Can I sell the company shares and at the same time also benefit from the dividends? How possible is that?
Well, you can't sell it in theory. You can't sell a company's stock price and actually benefit. It's very, very possible for you to do that. And you can do that after the ex-dividend dates, because once you buy and you hold till the qualification date, any investor whose name is on the registrars after the qualification date, which is the ex-dividend date, will be qualified to receive the dividend. So on that date, you can't sell. However, whether or not you're selling on profit will depend on your entry price and the exit price after the qualification date. So if you buy a stock at 10 naira, for example, and let us say the dividends is declared, the stock is now trading at 13 naira. Already you're on 30% profit if you can do a simple return on investment calculation. Let us say on the ex-dividend date, the stock is now trading at, let us assume, 15 naira per share. On the next dividend date, of course, the 1 naira dividend declared will be subtracted from the stock price. But you can still see that your return on investment, you still have a 4 naira above the price you paid for the dividend, the stock rather, right? So you can go ahead and sell on the ex-dividend date, right? And basically make your capital gain and still be qualified to receive the dividend. So in this case, in this situation, you can have your cake and actually eat it, but much depends on where the stock price is going to be on the ex-dividend date. It will not be advantageous if the stock is now selling at, say, 8 naira per share on the ex-dividend date and you bought it at 10 naira, right? It will not be advantageous to you because you will still be qualified for the dividends, but you'll be probably selling at a loss. So I hope that clarifies a few things.
Oh, yeah, that it does. It does. And for those listeners, if you don't really get what he's saying, you could engage with us on our social media handles, and we'll be glad to engage with you as well. There's so much to learn about dividends, because the reason why I'm asking Aye these questions, so that you can understand more about what's going on, is that most of us as retail investors, we look forward to dividends because they are a way that we can um, see the benefit of our investment, especially those people who are long-term investors. And remember, we talked about in previous episode, we talked about compounding. The dividend is a way of compounding your investment and creating wealth. Once you get your dividends and you decide to put everything back into the particular company that paid you the dividends, then subsequently, when they want to pay another dividend, assuming you did not increase your stake after you reinvested your dividends, um, you're bound to receive more, even though if the company paid the same amount of dividends the next year. If they paid 1 naira this year and they decide to pay 1 naira next year, because you reinvested the 1 naira that was paid this year into the company, next year you're going to earn more than what you earn this year because you reinvested everything back there. That's what we call compound interest. If you do that subsequently over a long period of time, you start seeing the benefit because your investment start increasing at geometric progression. We have people that we refer to as traders. These are people that are actually interested in capital appreciation, which is another benefit of the stock market. That will be the next on this series of benefit of being an investor. They are more interested in price movement. They want to enter low and exit high. That way they make profits. It's been a great one today, and I hope you also enjoyed this episode because my co-host did a very wonderful job, and I hope you like it. And we'll be very happy to hear back from you and your responses and your constructive criticism and all that. Thank you so much, Aye. Any final words before we call it a day for this episode?
I think you've basically said it all. Yes. Interestingly, we'll eventually talk about capital appreciation. I just want to point out that while dividends are very good and healthy, predictable return on investment, capital appreciation tends to be the major benefit of being a shareholder. And as unpredictable as it is, it is still a very, very, very good and very, very healthy return on investment. Even if you're a long range investor, we encourage you to tune into our next episode and when we talk about capital appreciation, and maybe we'll even tell you a few tips and tricks and strategies which you can use to manage your expectations and your patience in capturing capital appreciation. So yeah, it's been a very interesting episode. I enjoyed I enjoyed presenting today's episode. So yeah, that's all I have to say, Moody. Yeah.
All right. Thank you for your time and thank you for sharing your wealth of knowledge with our listeners. Have a nice one.
You too, Moody.
Thank you for listening to another episode of the Nigerian Investors Podcast. We hope in this episode you've learned something very valuable that you can use in your day-to-day investing life. We also want to encourage you to share our episodes on all social media platforms. Share with friends or family. Never can tell whose life will be changing positively. Our social media handles can be found at the show note below this episode. We also have a website where you can listen to our episode free of charge. For those who don't have subscription to podcast hosting sites like Apple Podcasts, Spotify, and Amazon Music, you can listen to our podcast on YouTube free of charge. We have an email address. You can send us an email if you have any question, any query or contribution. And if you also want to be interviewed, you can also reach out to us. Email address tnipodcaster@gmail.com. Continue to share and like and spread the news to all friends and loved ones. Thank you. TNI Podcast is produced by Aye and Moody. Thank you once more. Until we meet again, have a nice one. Bye.